Good morning, everybody. Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning with this week's market breakdown video. If you like the content, please subscribe to the channel so that you can see this on a weekly basis. And this week, we're going to be covering the four major U.S. indexes. We're also going to take a look at oil, and we will also jump in and take a look at the emerging markets. We have some interesting data points to take a look at that have a lot to do with retail traders and their option bets and what that could mean for us moving forward. So let's jump right into it here. The S&P 500 has had a strong week thus far. You can see we had two lines drawn on this chart, and this is really our major resistance zone that has been in play now going back until last June, and that's that 29.50 to 30.30 level. And you can see that we have failed every time we came up to that 30.30 in that last year until we ultimately had the breakout. So that's really the major key is can we get back up over 30.30? But you'll notice for the first time here this week, we broke into that resistance zone. We haven't traded back in there since about mid-March. So that is certainly some good action out of the bulls. But the battleground that we're going to see here is really, really important. So the bulls certainly have done a little bit of winning here this week with that nice reversal from the end of last week and push higher into that resistance zone. We're going to have to pay very close attention to what continues to happen over there. Now, the Nasdaq, complete monster. It has been the leader all year long, and you can see the level that we had drawn on the chart from last week. This was that gap resistance zone from back in March, and we got up cleanly above that yesterday. In fact, when you take a look at how far away we are from the highs, we are 2% away from all-time highs. So we are really, really close here, and it's not going to take much to actually push the Nasdaq into all-time high territory. This is a very strong V-shaped rally. And of course, when we get to that all-time high level up there at that 39.40 area, that should act as some sort of resistance where we would encounter some at least short-term pullback. So you might see something like this happen moving forward. But again, very, very strong action so far out of the Nasdaq, clear leader, and we continue to see strength. Next, we want to jump in and take a look at the Dow. Now, the Dow's still below that resistance zone. So remember, the S&P 500 is pushed up into that zone. The Nasdaq is broken out, is almost at all-time highs. And here is the Dow, which is still below that low from last June. So this whole zone right here is going to be that difficult area for the Dow. It failed once, it's failed twice. Can it push back up over it? That's what we're watching for here. It's really, really important to see that full picture out of all of the indexes. And when we talk about indexes having issues, of course, we have to jump in and take a look at the Russell, which has just had the worst year out of all of the indexes. And when we look here, that major resistance zone, again, we've mentioned it many times, the 1270 to that 1350 zone, it's right in here, right? We have traded up into that over the last month or so and thought we were going to get that breakout over that 1350 on that really, really strong move. That was immediately and sharply rejected. Of course, it found support down in here, and then it's bounced back up. So 1350 is really that important key level in on the Russell. If we get back up over that, we really don't have any resistance to encounter until we get back to that 1450. And this is that gap down zone, 1400 to 1450 on the Russell. And that, again, is equivalent to the gap down zone that we have in here on the Nasdaq. You can see, again, I mean, Nasdaq's well above that at this point. And when we look at the Russell, we haven't even gotten above this line. So we're still seeing that lag out of the mid and small caps. We're still seeing issues out of the Dow itself. But the Nasdaq leadership has been exceedingly strong. So it's still kind of a very bifurcated market. We're going to continue to pay attention to it. You know, is Nasdaq going to, continue to take us all the way up? Is everything else going to play catch up to the Nasdaq, or is the reality of a much larger number of companies in the S&P, the Dow, and the mid caps kind of more so telling the truth? That, of course, is yet to be seen, but we will continue to pay attention to it. Now, we've talked about oil a ton. When we look at this chart, all right, we had just a horrendous March. In fact, the front month, went negative. We discussed that in depth. But the two areas that we really had drawn out on the chart was that resistance zone from 27 to 33, which we broke above this week. And then that next resistance zone comes at 35 to the gap down at about 42. We're basically right there. A push above that would see the highest oil prices we've seen since the major breakdown happened at the beginning of March. So this is a very, very key level to watch on oil. Again, when we talk about things from a technical analysis standpoint, we could fail there at that resistance, come back and test what was resistance, which is now support, before making that next push. That would be an acceptable way for that to play out if it doesn't, make the break right now. So the two things that we're really watching here is, can we get up over 35? And if we can't get up over 35 on this push, do we hold this zone? If we fall back below that, that of course would be the big negative. So we're going to continue to pay very close attention to what is going on over there at oil. Now, when we talk about oil, of course, we want to take a look in at the emerging markets. Now, we have gone over this chart a number of times where we really spent a lot of time in the last couple of years inside of three different ranges. The bottom end of that range is about 750, and then the top end of this range is about that 940 zone, and that's what we've rallied back up into. And you can see the area that we have circled up on the chart. This is the same area that acted as support back in 2018, the beginning of 2019, and here we are once again at that zone. What happens here is really, really important. This is a very bad time for price action to ultimately fail after this nice sharp rally. You want to see that follow through into that next box. That would be very good action. If we were to fail right here, that of course would be the worst possible time for that to happen. So we'll have to continue to pay attention to what is going on in the emerging markets. We have a lot of really interesting data to take a look at this week. When we're talking about the emerging markets, we take a look at the MSCI World Index here in this chart. Almost all of the indexes are above their 50-day moving average, but all are almost below their 200-day moving averages. That is a very interesting data set, showing that we've got that sharp short-term rally, but we still haven't broken over those long-term major resistances. That gives us this data set to take a look at. When we look at this, we can see that 2 weeks later, only 17% of the time are we positive. A month later, 50, but 2 months later, 17, 3 months later, 33%. And then when we get out towards about a year later, things end up being better in terms of this particular data set. But you can see we had this happen a number of times in that first kind of low inside of a bear market. And it stands to reason, right? We have that initial short-term bounce, but we run into that major long-term resistance and things tend to kind of roll over. That's what this data set is saying. Now, again, there's only 7 instances of this happening, so it's not a huge data set. But what it does tell us is, and when we look at all the charts, we're at major resistance zones. It does make sense when we look back historically for the market to run into some difficulties here. When we look for that same data set and take a look at the impact that it has on the S&P 500, we see similar kind of results. The numbers are better for the S&P than they were for the emerging markets, but 2 weeks later, we're only positive about a third of the time. 2 months later, half the time we're positive. 3 months later, we're only positive 30% of the time, and it's a big skewed negative risk to reward. Where when we have a downside movement in the next 3 months, those are some pretty big numbers of around 10%ish on them. So this is again something that we just need to pay attention to right now very closely. We take a look at a similar data set for the S&P 500 in terms of its breadth, taking a look at the percentage of stocks that are above their 50-day moving average versus those that are above their 200-day moving average. We can see the same thing. We got medium-term surges within long-term downtrends. So let's take a look at what that data set looks like. Unfortunately, there's only 3 instances that actually trigger in this, so it's not a huge data set once again, but the numbers are very similar to the last one we looked at, where 2 weeks later, a month, 2 months, 3 months. They're not great numbers. And again, we can see really negatively skewed risk to reward. It's because, again, we're trading a lot above the 50-day, but below the 200-day moving average, we've got those medium and short-term rallies in the longer-term resistance that tends to happen inside of bounces in longer-term downtrends. So that is, of course, the concern that we have at this moment. The last thing I really want to pay attention to is taking a look at option data from small traders versus large traders. As you guys know, when you're watching these videos, I like to pay very close attention to extremes in sentiment and behavior, especially when it comes out of the retail traders side of things. Right now, small traders have opened a lot of bullish options contracts. In fact, it's a record high, which exceeded the week of February 14th before all of the massive sell-off. But this is a huge increase in retail option bets. And this is in the millions of contracts. So when I see something like this, it certainly makes my eyes open and go, we might want to take a little bit deeper look at this. So we can also look at this data in terms of what large traders are doing. And you can see they are a lot less bullish here than the small traders were. And in fact, we have another data set that will show you the difference between the two. This one being small traders minus the large traders net bullish open option contracts. And here we are right at that same zone that we were at from that first really big push lower in 08, 09. And again, when you look at this data set, what happened after that point? We went down. We had that little bit of a drop there. When we look at the data set for, stock trading above their 50 but below their 200, that was kind of triggering right in the same point in time. And when we look at the amount of option bets that retail traders are making right here, you get kind of a very similar setup, which is a concern. Now, the last thing we took a look at was the number of options contracts. Of course, the really important thing is taking a look at the dollar value that's associated with that as well, because again, people could be buying very long-term out of the money call options that are very, very cheap, which wouldn't really have an impact in terms of dollar value. So we also want to take a look at the dollar value here. And this is money in billions in this particular chart. And this is, again, small minus large trader net, bullish positions. And if we look at other times in history where these things really spiked, it was back in here in the beginning of that 2000 dot-com bubble crash. Here it is at the end of 2007, middle of 2008, where we have that. And, not all of it has been extremely negative, right? We had that happen in here too, and market did push higher. We had, a move here after the election, the market did push higher, but here we are at a very, very big extreme right up here in terms of price. So basically my takeaway from all of this, guys, is we've got retail traders making extremely bullish bets, a lot more so than large traders, which of course is a bit of a concern. We have a lot of stocks that are trading above their 50-day moving average, but are still below their 200-day moving average, running into those major resistance zones. This is something that we are going to definitely have to pay a lot of attention to moving forward, as we are at very key levels across a lot of charts, and even things like commodities in terms of oil. So what happens here over the next couple of weeks, I think, is very, very important, and we are going to continue to be here to analyze it all for you guys. As always, if you guys have any questions or comments, you can reach me at mtedeschi at Perspective Wealth Planning. You can pick up the phone and give me a call at 814-580-9881. I'm more than happy to talk anything related to the markets with you guys. I hope you have yourselves a fantastic week. As always, I will see you guys next week. Take care.